The following workshop was previously recorded. The content of this broadcast and the opinions expressed within are intended to be exclusively for informational and educational purposes only and should not be viewed as advice. Today's speaker is Mr. Frank Rydell. Mr. Rydell is a certified estate planner and a retirement income strategist.
Hello, everyone, and welcome to the presentation. Today, we have with us Mr. Frank Rydell, co-founder and executive officer of Hurricane Financial. Mr. Rydell is the certified estate planner. He is also a certified financial fiduciary. Welcome, Frank.
Thank you. Thank you, Roger.
Frank is also the author of the book, the best-selling book, What Keeps You Awake at Night? And with that, please tell us more about this banking policy strategy.
Yeah, thank you, Roger. The banking policy strategy is something that's near and dear to my heart. It's something that I've been doing personally for nearly 15 years now. And as we go through this presentation, I'll talk about how I actually used a type of insurance policy that a lot of people refer to as a banking policy as a way to actually recoup all the mortgage interest and remaining principal payments on my house by paying off a house. So we'll go through a couple scenarios, and I'll show you some ways that this banking policy strategy can really have a major effect on your financial future. One of the things that's having a big effect on people today, especially if you're a person who likes to watch the news a lot and you're captive and you're at home and you've got nothing else to do except watch the news channels, I might suggest you go find a good movie or something, because the news channels are not saying a whole lot of anything positive about this. It seems like this has become a firestorm really, really quick. And so it's affecting things. As you know, a lot of people are in shutdown mode and that type of thing, but it doesn't mean that you have to be in shutdown mode when it comes down to your financial future. The smart people get out there and get ahead of things. And, there's that old saying, the early bird gets the worm. Right now it's quiet, across the country, largely in the business community, but things are still happening behind the scenes. People are still doing things. People are still putting things together and building, because this virus won't last forever, likely be done in a matter of weeks. So you have a choice. You can kind of just sit back and put your head in the sand, or you can look at trying to do something for your future.
Frank, why is it that this banking concept seems to be so difficult for people to understand?
Well, it's because professionals typically who are trying to explain this, in my opinion, I've seen a lot of them, are really coming at it from the wrong angle. A lot of professionals come from an insurance background, and the angle that they're taking with infinite banking is they hear insurance, and initially they think that, wow, insurance is just a wonderful, banking is a wonderful way to try to sell insurance. And it's really not that at all. Banking and the concept of banking has been around for a long time. Bankers know how to make money in any environment. And so even in an environment like we're in right now with a virus going around, banks are still going to be profitable. You have to really think about that. Insurance people tend to look at the insurance component of this, and I think a lot of times, because I've talked with a number of insurance people, that insurance people come up from the perspective of, if I can sell people on this idea of banking, it'll help me sell more insurance policies. Because let's face it, insurance is not terribly exciting to sell. So what I see is a lot of focus on insurance and not enough focus on banking, and it leads to confusion, because you cannot really effectively describe how a banking policy works if you just simply dive into analytics. It's more conceptual than it is numbers. And we'll cover that a little bit more as we go through here. But this is an example of what I'm talking about. Most insurance policies are built for death benefit. Most insurance agents sell policies that are built for death benefit. So the idea of selling something that's built more for the banking component is foreign. So not only is it hard for a lot of people to explain to their clients, and even on, I've sat in in my career with, I don't know how many podcasts and different live events that people have had, and it's all designed to sell you on the banking concept. And I have found in a vast number of these that I've watched over a 15-year career, I will tell you there's been like one or two where somebody actually explained it right. Um, it's not about death benefit. It's about cash accumulation. It's about cash accumulation in a safe environment, in an environment where you can really have earnings that are unlimited based upon your own imagination. So you're building a policy, you're owning a policy, you're constructing a policy that is designed more for banking, about 80% of it for banking, about 20% of it is really housed within the insurance. Now, if you have the wrong insurance policy or the wrong insurance company or the wrong insurance features or the wrong insurance advisor, you probably don't have a banking policy. So the banking policy strategy is called by a lot of different things. Some people refer to it out there in the communities. You'll hear it referenced as infinite banking, bank on yourself, a whole bunch of things, privatized banking. I've heard maybe 6 to 8 different ways of describing this policy just in the past probably 6 to 8 months. So there's a lot of ways. Everyone seems to come up with some idea. To boil it really down, you can take away all the different titles and definitions of what it is. It really is a banking policy. It is a policy that is uniquely designed for the purpose of banking more than it is insurance. But it's attracting a lot of people like a bright light in a world where you have a lot of burned out ideas, like these bulbs that you see here on your screen. A lot of burned out ideas. People are attracted to the bright light. And this is something that's been going on. It's not a new concept. It's not something that just happened in the last few years. This has been going on for a long, long time. So let's use a quick example of how somebody would use this to pay off credit card debt and to recoup the debt. I mentioned that I'd use it to pay off a house. We'll get to that in a minute, but let's show you what would happen with maybe a smaller banking policy if you didn't have enough to pay off a house, but you had enough to pay off credit cards and you had some debt. So let's say that this lady here has cash value in her policy. She takes out money out of her banking policy. She takes out that in the form of a loan. Here's something that's interesting. Right here is where people who don't really understand it, and I'm probably speaking more to the advisors and agents than I am the public, but the people that don't understand it will say, well, Frank, why would I take a loan and pay interest to borrow my own money? Well, the answer is simple. You're not borrowing your own money. You're borrowing the insurance company's money. You're borrowing it out of their general fund. And if you have the right recognition factor, which would be, in this case, non-direct recognition, you're able to benefit and see your policy grow even though you have a loan against it. If you had a directly recognized policy, it is going to have a direct effect on how much you're earning in that policy. So again, having the right features, the right company, the right policy, the right advisor is key. But this lady can take policy loan out of the insurance company's general fund equal to the amount of cash that she has in her policy. So she can leverage up to that amount that she has. These policies are high cash value from the get-go. She's going to take this cash and pay off credit cards. When she pays off these credit cards, she doesn't just put her feet up on her desk and say, wonderful, I just paid off Capital One and Bank of America credit card, and now I'm home free. She's going to go ahead and take those same payments, maybe add a few dollars to it, and put that back into a uniquely designed rider that's associated with the policy that's called a paid-up addition rider. Now, that paid-up addition rider, I want you to think about it this way. Up above, you see a bank. This is kind of your policy. I want you to visualize this like your bank. Now, when you have that bank and you put premiums into it, that goes into the front door. So I want you to picture, a building that has a front door and a side door. So that front door is where premiums go in, and that helps pay for the cost of the insurance, gives you some cash value, but it really builds the construction of the policy more than anything else. When you put these extra dollars that you're saving through credit card interest back into the policy, you're not sticking those funds into the front door. You're going in the side door, which is called the paid-up addition. Paid up addition rider is just another way to put funds in the policy, but it has a completely different cause and effect. So what happens here is she ends up funneling that into the paid up additions. That buys paid up addition, policy values, and the bank grows. So again, we're using bank as an expression. This is an insurance policy. It's just uniquely designed to do some things over and above just simply pay a death benefit.
This is a rather interesting concept, Frank. Are there any restrictions or limitations to using the cash?
Not really. As long as you have available cash, you don't have to justify with anyone that you're going to use the funds for some reason. If you have $10,000 available cash, you can take out a $10,000 loan out of the insurance company's general fund, and it'll reduce the amount of available cash you have available, but your policy will still be growing because of the recognition factors. But what you really can see here is that you can use the cash that's in the policy, which builds up very quickly. And I'm going to reference a 50-year-old going out to age 121. Now, we're not expecting a 50-year-old to live to age 121. Yes, it could happen. But what you're going to find is cash value is building quickly over a period of time. Now, it starts out the first year somewhere in that range, depending upon how a policy is constructed. It can start out, 50%, 60%, 70%, just depends on how it's constructed. But it can get to high cash value within a couple of years very fast. And if you're using it right out of the gate, it could be an effective banking policy day one. Just depends, again, how it's constructed. Cash is available in here. You have a death benefit, and you can pay off debt. You can also use it for investment opportunities. When you earn dividends on a policy, again, this is a mutual insurance company. One of the other keys with this is people don't really understand the difference between mutual and stock-owned companies. You won't typically have the riders in a stock policy to be effective for a banking policy. What you're typically going to find is that in a mutual company, which is what we use, dividends are earned and they're paid to you. Because as a mutual policy owner, you own a little piece of the company. If you use a stock company, who makes the money, who really profits on this whole thing is the stockholders. So you want to use a mutual company. You want to have the right recognition factor. So these are all keys. So when you earn a dividend in this mutual policy, it automatically rolls back into the side door, which is the paid up addition door, to the limits of what the MEC limit is. And we'll get to the MEC limit here in just a second. But that dividend obviously is immediately getting reinvested back in. And now as you have debt, if you paid off those credit cards, like the lady I just showed you, paid off the credit card debt, that money then can be put back into the policy, that's savings, and see the policy grow. So you basically have recouped all of the amount of money you used to pay principal and interest on those credit cards coming back to you. So investment opportunities will be another way that you can go about this. But really one of the keys that really caused this whole banking policy strategy to have to be built a certain way was a law that was passed in 1988 called the Modified Endowment Contract Law, often known as the MEC law. What you find with the MEC law is simply this. The MEC law is a limitation on how much you can put in based upon the amount of insurance you have. So the MEC law or MEC limit is, think of it like a line in the sand. It separates the investment world, which is taxable, from the insurance world, which is non-taxable. And so you want to stay on the non-taxable side of the line, which means you want your banking policy to function like an investment, but still be housed within an insurance policy and still qualify as an insurance policy, so it doesn't qualify as a modified endowment contract. See, if you don't build the policy right, and this is very critical, if you're not going to write down too many things here, write this one down. This one you might want to actually get a tattoo on your arm so you don't forget. This is critical. Policies oftentimes are misdesigned from day one. So what do I mean by that? I mean that if you have the wrong advisor, the wrong agent, the wrong person designing that policy, it may not be a MEC day one. It may not be a MEC day two. But I can tell you, oftentimes I see policies that other people build, and if you use them the way that they're designing them to be used, they become a MEC in year 5, in year 7, year 10, which means that you could build up this financial empire for yourself and have it all become taxable. What's the point of doing that? Now, oftentimes I see these policies, and when somebody brings me one from somebody else, and I'll say, Frank, I don't know what went wrong. This guy seemed to know what he was talking about. And I bought this policy 5 years ago, but now it's a mech. And you do the research and you look at it and you find out that didn't just become a mech. That's been a mech for 5 years. That was a mech the day they wrote it. They just didn't know it. So you've got to be really, really careful. So this mech law is a real deal, but it's not something that should paralyze you. You're working with the right person, somebody who knows what they're doing, will design it right. And so that's why you need to use someone that's an authorized person that really understands conceptually how this works. So one way that we build these policies to be able to create the type of limit that you need to put extra payments back in is we've got to get that mech limit on the left over here higher than the base premium. The base premium is going into door number one, the front door of the policy. So what you've got to be able to do is you've got to be able to get that mech limit to go up higher, significantly higher than what the base premium is. So that when you're putting additional funds back in the policy, you're not creating a taxable event. So how do we do that? We do that by designing a policy that is going to have banking features, and we're also going to put on a certain type of rider, actually a couple of types of riders. We're going to put on a strategically placed term rider and a PUA, a paid-up addition rider. That paid-up addition rider creates a second door, a side door into the policy. So what you see up here where my mouse is moving around, you're going to see that this is the second door of the policy. This is another way to put money back into that policy. A different calculation, a different cause, a different effect. So as you put money into base premiums, that's going to build the foundational structure of your policy and keep this from becoming a mech, because if you build it right, you can move that mech limit all the way up to what you see on the left. It was, prior to us putting this rider on, it was right on top of the base premiums, which means that if you did use it for banking, it could become a mech at some point. But if we can create more headroom by moving it higher, you do so in the most cost-effective, cost-efficient manner, then you really have something that you can utilize that can benefit you. But again, there are construction elements here, but don't let this hold you up. Don't let this freeze you and have you say, hold on, it's too confusing. I had a banking policy that I used, as I mentioned, to pay off a house. I'm a licensee and I work in the industry. And yet it took me, when I first heard about this 15 years ago, it took me almost a year to understand it all. So I had a policy in place, I utilized it, and I had to learn as I went. So one of the advantages for you is that if you're working with someone that really knows and has experience, you're going to be able to glean information and knowledge from them and their years of experience, and you're going to be farther ahead than where I was. I didn't really have that. I didn't have an experienced person to kind of bring me along by the hand and show me how to utilize this policy. I had to figure it out on my own, but it wasn't that hard. It just took time. You're going to have the advantage of working with someone who is going to be able to take you through this step by step by step, and not just show you how to do it right, but how to maximize it. So whether you're paying off a house, which is an example of what I did, was use mine to pay off a house, or you're using it for generational estate planning, as a certified estate planner, one of the things that you'll find in most people who have taken time to set up a will or a trust, especially a trust, if you look at a trust, for instance, a lot of components within a trust center around life insurance. So trusts typically are heavily loaded with life insurance for one reason, and that is the generational value of passing on an estate from one generation to the next, and doing so in a tax-efficient manner.
So Frank, as an example, what would happen if this family was debt-free? Could they still use this banking policy?
Yeah, so if a person is debt-free and they're really coming into this looking at it saying, well, I don't have credit cards and I don't have a mortgage, and I would say, congratulations. Now you get to use it for asset accumulation. So if you have investments that you're interested in, another great place to utilize the insurance company's money, leverage their money against your policy to go out and acquire assets. So here's what I'm talking about. Let's say you're really into gold or silver or precious metals. This is just one idea. I'm not advocating that you go out and buy a bunch of precious metals. I'm just saying that some people do. And if you're into that kind of thing, then there's your investment. It could be anything. But let's use an example. And let's say that gentleman and that family that we just referenced, he says, okay, well, I'm going to go out now and I'm going to take some cash value out of my policy. And I'm going to go over here and take a policy loan. I have the right recognition factors. I'm going to use the cash. My policy is constructed properly, so I'm not worried about a MEC. And I'm going to go out and buy gold. And let's say that over time, gold goes up and he sells it at some point in time, or he profits in some ways, and he wants to now recoup the profits, put it back into the rider again, just like the other lady did with that, putting money into the PUA from paying off credit cards. He's going to turn around and sell the gold and then put the money back in. So I'm not saying he buys the gold and sells the gold. He might sit on the gold for 2 or 3 years, but let's say it goes up in value. Silver had done that in recent years. If that's the case, he now can take that money, put it back in the policy, and that family banking system, which is completely conceptual, not a real bank, it is a banking concept, it grows. So really, you have to look at it this way. So we'll wrap up with a couple of points here. On the left, you see a regular traditional insurance policy, something that's just simply built for a season of life and death to come at the end. So it's pretty much a gray, black and white type of scenario. You know, you buy it, you try to get the cheapest insurance you can buy and get the biggest tree or the biggest death benefit you can get. But you know, there's that picture on the left isn't terribly exciting, and that's just completely different than what you see on the right. What you see on the right represents a banking policy. It's full color. It's dynamic. It's got a completely different view to it, a completely different vibe and effect. So whereas the insurance person or the advisor stuck with their head on the desk that's struggling to explain it, oftentimes they'll find themselves on the black and white side of this slide, and they're looking at the policy incorrectly. That tree represents the policy. They're trying to position it with their clients or their folks, that whoever they're talking to, just like you see on the left. And really, they're missing the magnitude of the entire policy, which is what's on the right. So focusing on insurance is where the mistake is commonly made. It's only seeing a portion of the picture. Meanwhile, the tree in full color represents the unique characteristics of a properly designed policy, something that is designed, again, for banking and not as much for insurance. So let's use an example. Okay, we're going to use the same tree. We're going to show you a policy that is well-funded, but it's an insurance policy. It's a non-MEC policy. I wouldn't do that to you. I'm going to show you a non-MEC policy on the left. It's going to be just a regular insurance policy, but I'm going to show you a high cash value insurance policy. Then we're going to show you the other side of the tree. And I'm going to show you what happens if you have a policy that's built for banking and now you're max funding it, which means you're maybe taking money out, you're paying money back. Maybe you don't take money out at all. Maybe you're just max funding the policy. See, a lot of people think that banking means that you've got to borrow money out of the policy to make it work. Not true. Some of my most successful banking clients are people who never take loans out. Physicians, for instance, who will simply use this policy, they'll fund it, and then they say, hey, I've got extra headroom in the policy. I can put another $25,000 in it this year, and they do it. But most people are not in that position. Most people need to use the money to amass more money. But if you're not in that situation, you're debt-free, and you've just got maybe more money than you can throw at this, fund it. Just fund it. Build it up. It becomes an amazing rainy day account. So what you see here is an example. We're going to go through some numbers. So again, I don't like to focus on just analytics and numbers, but I think it's important we show something here. These numbers come off an illustration, word for word, number for number, line for line, off of two actual illustrations that I ran to take a look at. So now, first of all, in both scenarios, we're going to show a male, 50 years old. The man is going to pay $10,000 a year in premiums in the first 10 years. The very first year, he's going to put $5,000. We're going to call it an extra capitalization. He's going to drop that in the policy the first year, and that's it. Years 11 through 26, he will start to see his premium come down by almost $400. In years 27 through 30, it'll come down even more. So I'm going to show you what this looks like over a period of time. First year, we know he's putting in $10,000 plus extra capitalization the first year. So what does that mean? Policy's cash value is this much, which means he has 64% cash value. That's pretty good. So again, this is not banking. This is just a regular insurance policy. Death benefit, $459. The dividend is scheduled to be around $585. The skip out 5 years. 5 years in, he's continuing to do this, pay $10,000 a year. Okay, he only did that extra 5 the first year, 10,000 years 2, 3, 4, and 5 and beyond. So he now puts in his 10,000. That's a cumulative amount that he's been putting in. So you look at the premiums paid, 84%, and now you look at the death benefit. So the dividend pays out. So the dividend's growing. Everything's growing. He's gone from 64% to 84%. Got 10 years now. And you can see what ends up happening. So in a regular insurance policy, if it's designed properly, it can be built for cash value. See, this gentleman's not really doing any kind of banking in this policy, but he still has a very efficient high cash value policy, a policy that is earning him a lot of cash based on what he's putting in. And so he has access to that cash. But let's say this same 50-year-old male goes over here and he says, okay, in a banking example, that he says, I've got a MEC limit now, it's much higher. And so I could actually put an additional $12,264 in the policy into the side door of the policy, the PUA door, in years 1 through 7. Well, he can redirect that money, and he's also then can redirect $11,555 in years 8 through 9. So then in years 10 and beyond, so in year 10, he's just going to pay a level $10,000 premium. And then in year, let's say 11, 12 and beyond, that premium will start dropping. So it might be half of that at that point. But we're going to just focus on the first 10 years. So because we could do this and show you slide after slide after slide and go out 50 years, and it's pointless. You can see enough here in the first 10 years to know if something works or not. So first year, he puts in now, he's max funding the policy. So this is the same guy, same policy, just built for banking now at this point. So what he ends up doing is by max funding it, which means that he's putting in the entire amount of the premium plus every little bit extra that he has up to the limits of the MEC he can put in. So what's happening is his death benefit, a little bit higher. And so you see the policy dividend, a little bit higher than what you see on the left. So let's go off 5 years. He's now, you look at his policy, this is the cash value increase over and above the premium, means that he's got cash increase of 192% over and above the premiums he put in. I love this part because this is where you always will find some person. And they say, hold on, Frank. Aha, got the aha, gotcha moment. You can't really say that because this guy is sticking all that money in, so all of those dollars are premium. No, his premium is what he's being billed. Okay, he's getting billed $10,000 a year. The additional monies he's putting in are most likely monies that he was paying somebody else in interest. The additional monies I put in my policy were monies that were actually going to the bank to pay a mortgage. Once that mortgage was paid off, I just redirected those payments back to myself. So those aren't just me putting in extra dollars because I felt like it. I actually utilized that money and used somebody else's money with leverage and transferred, just basically redirected payments from the bank back to the policy. So absolutely, so in this scenario, your cash over premium be 192% at 5 years with this particular structure. Again, every policy is different. Every 50-year-old's policy is going to be designed differently. It just depends on how you construct it. So they'll go out 10 years. As we wrap up, you'll see he's got 218% over and above premium. So the policy on the left at 10 years is very good. It's a high cash value policy. That is not your grandfather's policy on the left. That's a high cash value policy. But this just shows you, if you take this high cash value policy and you were to try to go with a max funding model, which means that you are taking additional dollars that you're able to recoup and channel it back to the policy, the effect is huge.
Wow, that's amazing just how much money a family can accumulate.
Yeah, not just that, but I mean, look at the death benefit difference. 901 versus 595. So imagine leaving 901 as a death benefit to your family versus only 595. and still having a lot of cash to work with along the way.
So Frank, in light of the shutdown with the coronavirus, and what would be the next step in the process if someone wants to meet with you?
Well, it's really simple. We have been doing this for a long time, and way years and years and years prior to any talk of any viruses, we have been doing web conference meetings with people. Very simple. Email a link. They click on the link. They can see us here in the office. I go through a scenario with them. It's usually 2 or 3 meetings. The first meeting to get to know them a little bit, answer their questions about banking, uh, insurance, and everything else involved. Second meeting to show illustrations. Third meeting typically to implement if that's what they want to do. But it'd be done through communication. So again, if you're sitting at home right now and you're thinking, maybe I'll wait this thing out and see what happens, maybe you think differently. Maybe you think this is the time to get busy. This is the time while you can't do anything else to really look at your financial future and figure out how you can have something that's going to help you. Because again, the virus is going to come and go. It's not going to be here forever. At some point in time, things will open up and get back to normal. They'll start playing sports again. All these things will start happening. You're going to want to take advantage of your time at that point. Having a structure already in place puts you that much further ahead. I want you, every time you think about a banking policy, I want you to visualize those 3D glasses that you see in the right. They're there for a reason. You have to look at this 3-dimensionally. So when we meet, what will end up happening is this. We'll go through an analysis with you, and we will talk what we talked about earlier, which is about 80% of this is concept, and about 20% of it is actually the insurance. We're going to talk about how money's flowing away from you, how it comes back. So we're going to replay some of the conversations from this appointment, this first meeting, and we're going to go back through. So a lot of what I was just showing you about how you can utilize the cash in a policy, it's like a transparency or an overlay. You've got to be able to see in black and white behind you, you have an insurance policy. You can't really illustrate banking in insurance software because insurance software is designed to show one thing: premium, dividend, death benefit. So, or a couple things, I guess, but it doesn't show you banking. So what you're going to find here is you've got to find a way to get those dividends to roll back in. You also have to find a way to raise the MEC limit. You've got to find a way to do this and benefit from the cash and access to funds without triggering a MEC, and doing so in the right, proper manner. That's a properly designed policy, working with a professional that really not just sells policies, okay, because any person can do that, but maybe somebody who's actually done this for over a decade and has used it personally in their own scenario over and over and over again. That'd be a good place to start. Someone with experience, I guess, is what I'm saying. So we're going to refresh you. When we show you numbers, we're going to take concept on the first meeting, which is what you see in most of that PowerPoint was concept. And then we're going to show you more numbers in the second meeting. But numbers don't tell the whole story. Remember the tree, the black and white side versus the full color side. I don't want to walk in with just pure insurance numbers because all I'm showing you is one side of the tree. We've got to take both sides and we got to overlay it. So it's sort of like this. We're going to look at these columns and we're going to actually remind you of how you utilize these columns to amass more within the policy. This is exactly when I talk about advisors or insurance people falling face down on their desk and giving up and just, I have, they call me a lot. I get calls from people in the industry all the time. Frank, you guys seem to be doing a lot of banking policies. I can't explain this to our clients, and it's simple questions. And I'm always willing to help. Anytime I can step in and maybe help somebody, because ultimately they're working with clients that are probably no one I'll ever meet anyway. So it's not really having an effect on my business. But if it can help them design the right policy for someone, it means that someone can actually get the right policy. So I don't mind helping out wherever I can. But the bottom line is the concept that you see here in full color on the screen is something that is often skipped. They're wanting to go to the numbers, to the black and white. So they're going to the black and white gray side of the tree, not the full color side that is concept driven. 80% of this is what's not printed in black and white. 80% of it is what you understand in concept. Hard. That's hard for people to swallow if you're very analytical. But if you can take your analytical hat off for just a minute and try to look through this through these 3D glasses through a conceptual lens, you'll be able to see it. And you'll be able to see how you can build generational estate wealth for not just your generation, but the generation to come and the generation to come after that, and so on and so forth, and do so in an estate manner that allows you to do it very tax efficiently. It's really about you having access to funds when you need it, building the type of personal system of finance that you need when you need it, but also being able to transfer something on and be able to help those that are coming behind you. I want to thank you for allowing me to come on here this evening and taking time to talk with you. Please take the opportunity to learn more about this and sit down and see an analysis for yourself and understand the impact and what this can actually do for you.
Thank you for attending this informational workshop. We hope you found it informative. The content of this broadcast and opinions expressed within are intended to be exclusively for informational and educational purposes only and should not be viewed as advice. Because results may vary, listeners are encouraged to seek professional advice whenever considering any concept, idea, or strategic approach. Start building a true plan of action today and say goodbye to unnecessary fees and risk. Call Hurricane Financial via phone today at 888-200-8161 or visit us at hurricanefinancial.com. Hurricane Financial, wealth, security, control in the eye of the storm.